Hello students, welcome to all of you Shiksha 360, and today we will start our first session basically on chapter number 6, that is risk in foreign trade. Clear? Basically this chapter is basically belong from the module A of BFM. Clear? And this chapter is very important. We have to discuss all the points. Clear? And side by side basically we will provide you some questions also for the practice. Clear? So let's start. So some questions will be provided to you in the form of PDF, and some questions basically after the completion of the chapter will be provided to you and in the Telegram group. Clear? In the form of discussion. Clear? So let's start. Basically, what are the risks basically we have to face in the foreign trade? Clear? I think all of you are aware that there is basically a fight going between Russia and Ukraine. Clear? Basically, due to the Russia and Ukraine, you will see that basically there are some issues faced by the traders. Clear? Like we will expect that the prices of the petrol will rise. Petrol, diesel will rise. Clear? So, and some other food items are also impacted. Like basically most of the Indians basically visit the Ukraine for medical study. Clear? This also impacts. Clear? So basically this is not a trade. Clear? This is not a trade, but we will see the impacts. Clear? But these are the trades. Like India basically export many food items, like we can say that like rice and many others. Clear? To the Ukraine. Clear? Basically these trucks are also standing in the a long way. Clear? Basically a long way to the route. Clear? Because they are not able to deliver the items to the respective place. Clear? Basically they are not able to deliver the items to the respective place. So let's start. Basically what are the different types of risk faced? Clear? Hope it is clear to all of you basically what we are saying. That clear? So basically for covering all these types of risks, basically there is an organization ECGC. We will have to discuss regarding that clear? Basically how it plays an important role in all these types of risks. Clear? So let's start. Basically the arena or area of international trade, clear, or the field of international trade is also not free from such uncertainties. Clear? Basically from risk uncertainties. Or in the international trade, basically what type of risk basically we have to face? We have to face buyer risk, seller risk, shipping risk, etc. Clear? These are very important. Is buyer risk, seller risk. Clear? Basically directly they will ask the question, basically who will face the buyer risk, who will face the seller risk. Clear? And in the international trade, buyer risk, seller risk, shipping risk, etc. need to be kept in view and managed effectively. So risks need to be accepted and managed effectively and efficiently. Clear? Basically risks need to be managed, or basically risk needs to be accepted and managed effectively and efficiently to minimize the adverse effect. Clear? Basically to minimize the adverse effect and maximize the profit and goals of the organization. Clear? Basically we have to accepted and manage the risk in that way. Clear? Basically accepted and manage the risk in that way, so that basically we have to minimize their effects on the organization, on the work, and maximize the profit and goals of the organization. Clear? And maximize the profit and goals of the organization. So international trade is largely dependent. Clear? Basically how it depends. Clear? Like we can say that if you are sending, basically exporting the materials to any foreign country of 10 crore. Clear? So any organization does not have that much funds. Clear? So basically their roles come out to the banks. Clear? Basically banks play an important role here. Clear? So international trade here, international trade is largely dependent. Clear? International trade, it is basically largely dependent on financing by banks. Clear? Basically on financing by banks. As such, countries have developed. Clear? Basically international trade is largely dependent on financing by banks. As countries have developed, what they have developed, basically export credit guarantee corporations. Clear? Basically they have developed that type of organization basically which provide them guarantee. Clear? Which provide them guarantee basically against these types of risk. Clear? Basically we can say that as an insurance work. Clear? Basically, they will provide them as an insurance. That if they face this risk, basically we will provide you the, or we will pay for that risk. Clear? So basically, international trade is largely dependent on financing by banks. As such, countries have developed export credit guarantee corporations, basically to take care of the credit risk. Clear? Basically to take care of the credit risks of the export financing institutions. Clear? Basically to take care of the credit risk of the export financing institutions. In India, basically this role, clear, basically which is in India, basically which is Export Credit Guarantee Corporation, basically ECGC. Clear? In India, basically this role is played by ECGC of India Limited. Various policies offered by ECGC to financing banks and exporters. Basically from this, basically we will expect case study. Clear? Basically which we have to discuss in the upcoming sessions on ECGC. Clear? ECGC financing. Clear? So various policies basically offered by ECGC to financing banks and exporters to help basically help ensure export finance and exporters money. Clear? Ensure basically how to ensure basically ensure export finance and exporters money, which can lead to growth of exports for the country. Clear? Basically which can lead to growth for the exports of the country. Clear? Basically if the exporters know that they will face this risk, clear, and their money will lose. Clear? So basically they will do less export. Clear? But if any agency will provide you the guarantee that if they will face this loss, you the money. Clear? So that is basically they will start exporting more. Clear? They will start exporting more. Clear? So ECGC. Clear? ECGC basically full form of ECGC is formally Export Credit Guarantee Corporation of India Limited. Clear? It is a wholly owned by the government of India, was set up in the year 1957. Clear? You have to remember this year, basically in the year 2018, basically they have directly asked basically in which year ECGC was established. Clear? So you have to remember that basically it is a wholly owned by the government of India and it was set up in the year 1957. Basically what is the objective? Basically with the objective of promoting exports. Clear? What is the objective of this organization? Basically with the objective of promoting exports from the country by providing credit risk insurance. Clear? With the objective of promoting exports from the country. How? By providing credit risk insurance. Clear? Basically credit risk insurance and related services for exports. Clear? Credit risk insurance and related services basically for the exports. It functions under the basically under which organization or under which ministry? Basically this ECGC function, basically it functions under the administrative control of Ministry of Commerce and Industry. Clear? You have to also remember that basically it functions under the Ministry of Commerce and Industry, and it is managed by Board of Directors. Clear? And it is managed by the Board of Directors, basically comprising representatives of the government. Clear? Basically whom are under the Board of Directors, basically comprising, basically it includes representatives from the government of India, from the Reserve Bank of India, banking and insurance and exporting community. Clear? From all these fields, basically experts are the members of the Board of Directors. Clear? Over the years, basically over the years, it has designed different export credit insurance products. Clear? Basically they are providing different facilities. Clear? Basically with the different products. Clear? Over the years, basically it has designed different export credit risk insurance products to suit or to fulfill the requirements of Indian exporters. Clear? To suit or fulfill the requirements of Indian exporters and commercial banks. Clear? Suit the requirements of Indian exporters and commercial banks. Basically how? Basically extending export credit. Clear? Basically extending export credit. ECGC is an essential and export promotion organization seeking to improve the competitiveness of the Indian exporters by providing them with credit insurance covers. Clear? So ECGC keeps its premium rates at the optimum level. Clear? Basically like we can say that if you are exporting the material of, we can say that 10 lakh, or we can say that not 10 lakh, 100 lakh. Clear? So basically ECGC, basically how much insurance they will provide. Clear? Basically we can say that 90%. Clear? Up to 90 lakhs. If there is any mishappening happen, they will provide you. For 90 lakh, basically how much premium they will charge. Like we can say that 5 lakh or 3 lakh or 50,000. Clear, it depends upon case to case. Clear, it depends upon case to case. Clear, and but they keep its premium rates at the optimum level. Clear, why? Because they want that Indian exports will increase. Clear, Indian exports will increase. Clear. So this is the main reason of the ECGC. Clear, this is the main reason of ECGC, to promote the Indian exports. Clear, basically to promote the Indian exports. Hope it is clear to all of you why ECGC is formed. So need for export credit. Clear, what is the need? Clear, basically we have already discussed that there are certain types of risks basically we have to face. Let's discuss this once again. So basically payment for exports are open to risk. Clear, even at the best of the times. Clear, basically are open to risk even at the best of time, because in this buyer and seller does not know each other. Clear, they don't know each other. Clear, basically who is buyer, who is seller. Clear. So the risk have assumed, clear, the risks have assumed large proportions today, basically due to the far-reaching political and economic changes that are sweeping the world. And outbreak of war. Clear, basically an outbreak of war, basically due to sometimes war, like we can say that in Afghanistan when Taliban captured. Clear, or in Ukraine. Clear, when Russia attacks. Clear, or civil war may block or delay payment of goods exported. Clear, or delay payment of goods exported. A coup or an insurrection. Basically, coup, what is the meaning of coup? Basically, sudden capture. Clear, sudden capture by any other or country. Clear, over the country. Clear, a coup or an insurrection basically may also bring the same result. Clear, like basically what the same result? That is block or delay payment for the goods exported. Clear. So the economic difficulties. Clear, the economic difficulties or the balance of payment. Balance of payment, I think all of you are aware what is balance of payment. Clear. If you are not aware, basically we have to discuss regarding that in union budget in chapter number 9 of ABM. Clear, in chapter number 9 of ABM. Clear, basically what is balance of payment. Clear. So basically basically economic difficulties or balance of payment problems may lead the country to impose restrictions on either import of certain goods or on transfer of payments for the goods imported. Like we can say that we are sending goods to the Afghanistan, but due to the sudden capture of the Taliban, we have goods already sent. Clear, that is basically exported. Clear, but they are not able to get their money back. Clear, they are not able to get their money back. Clear. So in addition, the exporter have to face commercial risks of insolvency. Clear, basically when the borrower is not able to pay the money, or basically the buyer, or protracted default of buyers. Clear, or protracted default of buyers. Clear. So the commercial risks of a foreign buyer. Clear, the commercial risks of a foreign buyer going bankrupt or losing his capacity to pay are aggravated basically due to the political and economic uncertainties. Clear, basically like sometimes basically there are some restrictions basically which are imposed by the country, and due to that basically they are not able to pay their dues. Clear. So export credit. Clear, basically due to this basically export credit insurance is designed. Clear, basically to protect from all these types of risks. Clear, basically to protect from all these types of risks, basically an export credit. And export credit insurance is designed to protect exporters basically from the consequences of the payment risk. Basically, what risk? Basically both political and commercial. Clear. And to enable them to expand their overseas business without fear of loss. Clear, basically without fear of loss. And one thing basically, as many students are asking, sir, what is basically balance of payment? Clear. So balance of payment basically I will just here briefly tell you. We have little bit space here. Balance of payment. So basically balance of payment, basically it is a simply basically how much we can export. Clear, basically how much we are exporting and how much we are importing. Clear. So basically it is a difference between. Clear, it is a difference between all money. Clear, it is the difference between all money flowing into the country into the country and outflow. Clear? How much money is flowing into the country and how much money is going out from the country. Clear? So the difference between them, that is basically known as the balance of payment. Clear? The difference between them, it is basically known as the balance of a payment. So what are the risks? Clear? So the definition of risks and risks in the international trade. Clear? So basically a risk, you have to remember that this is 1 mark question. Basically a risk is an which type of event. Clear? A risk is an unplanned event. Clear? Every year they will ask question in the examination of BFM. Basically a risk is which type of event. Basically it is an unplanned event. Clear? A risk can be defined as an unplanned event with the financial consequences. Clear? With the financial consequences or financial results resulting in loss or a reduced earning. Clear? Basically a risk can be defined as an unplanned event with the financial consequences. Clear? Basically with the financial consequences resulting in loss or a reduced earnings. Clear? Resulting in loss or a reduced earnings. Clear? So an activity which may give profit or loss. Clear? An activity which may give profits or result in loss may be called a risky proportion. Clear? An activity basically which may give profits or results in loss may be called a risky proportion. Clear? Basically due to the uncertainty or unpredictability of the activity or trade in future. Clear? Basically an activity which may give profit or result in loss may be called a risky proportion. Clear? Basically may be called a risky proportion. Basically why? Basically due to the uncertainty or unpredictability of the activity or trade in future. Clear? Because we will not know basically what will happen in the future. Clear? Similarly, while in the human life, what type of risk? Clear? Basically while in the human life, basically the risk related to the illness, impairment or loss of life. Clear? And in commercial and business activities, the business profit or loss would depend upon, clear, how the business is ran or its affairs are managed. Clear? Basically how we can do our business. Clear? Or how our business is going. Clear? Basically it depends. Clear? It depends upon the business management. Clear? Basically how much we will earn the profit or how loss, how much basically we are facing the loss. Clear? It depends upon all these types of things. Clear? So now in other words, basically it can be defined as the uncertainty of the outcome. Clear? Basically it can be defined as the uncertainty of the outcome. Clear? Like we are doing some work, but we will face anything there that is basically known as uncertainty, and that leads to the reduction of our profit. Clear? Or it impacts basically bad impact on our business. Clear? A risk in any currency. Clear? A risk in any currency, commodity or an object. Clear? A risk in any currency, commodity or an object is due to an exposure in that particular currency, commodity or object. Clear? Basically when we face that risk, basically when we are involving in that. Clear? Like if you are not doing the business. Clear? If you are not doing the business, then you will not earn any profit or loss. Clear? Till you are not indulging in anything, you will not get any benefit. Clear? So like currency risk, clear, like currency risk, commodity price risk, interest rate risk, it is an integral part of the integrated national trade. Clear? This question they have already asked in the year 2021. Basically which of the following risks? Clear? Basically which of the following risks are part of an international trade? So the currency risk, commodity price risk and the interest rate risk. Clear? The currency risk, commodity price risk and the interest rate risk. Clear? And the interest rate risk are integral part of the international trade. Clear? Are integral part of the international trade. Clear? So international trade is affected. Clear? Here international trade is affected by a number of additional risks. Clear? International trade is affected basically by a number of additional risks, basically more than those than the domestic risk. Clear? Because in the domestic risk, basically we will not face any currency risk. Clear? Because in the whole country, basically same currency is going to be prevailing. Clear? But in the international trade, basically we have to face that risk. Clear? Why? Basically there are more risks in the international trade, because this is because of its vast arena of operations. Clear? Because different countries have different policies. Clear? Basically where the buyer and seller are located in different countries, the goods and the values of goods basically move in opposite directions. Clear? The currency of the country of the buyer and the currency of the country of the seller have their own values, which undergo frequent change frequently. Clear? Basically which undergo frequent change frequently. Clear? While the invoicing while the invoicing may be in a third currency acceptable to both. Clear? Like we can say that India is dealing in rupee, and basically they are exporting the things. Basically, we can say that to the Dubai in the dirham. Dirham is dealing, basically Dubai is dealing in the dirham currency. Clear? But they are not basically accepting at the world level. Clear? Basically, so basically they are generating their invoice in the dollar. Clear? That is, they are saying the same thing here. Clear? Basically, buyer dealing in one currency, seller dealing in different currency, and invoicing is done in any other currency. Clear? In the third currency. Clear? That is acceptable to both. Clear? Sometimes it is possible to identify. Clear? Basically, sometimes it is possible to identify, isolate. Clear? Sometimes it is possible to identify, isolate, and quantify the risk. While at other times, basically, it may be not possible to do so. Clear? It may be not possible to do so. Clear? Why? How basically we can identify or isolate and quantify the risk? Basically, like we can know that basically there is rating given to all the countries. Clear? Basically, there is rating given to all the countries. That is, basically, it depends basically how much these countries are favorable to the business. Clear? Basically, how much these countries are favorable to the business. Clear? So on the basis of that, basically, we will know that basically in this country we will face that much risk. Clear? So basically, we have to aware ourselves. Clear? Regarding those risks. So now let's discuss basically what are the different types of risk basically we have to face. First one is the buyer risk. Clear? Basically, buyer risk is to be faced by the seller. Clear? Buyer risk is to be faced by the seller. Clear? You have to remember that basically under the risk in foreign trade, basically these are some types of confusions. But when we will discuss the definition, it is clear to all of you basically why I'm saying that basically buyer risk it is faced by the seller. Clear? So basically the seller. Basically here the seller faces risk. Basically what type of risk? That is relating to non-acceptability or non-payment or quality acceptance or credit risk, etc. Clear? Like we can say that here A is the seller and A selling the things to the B, but B here does not accept. Clear? B here does not accept that they are not requiring presently these types of things. Clear? Earlier they will require, but there is now not a demand. Clear? Or basically B accepts a thing but not payment. Clear? Not doing the payment. Clear? Or they can say that basically this quality is not up to the mark basically which I have ordered. Clear? So they are paying less. Clear? So these types of risk are basically faced by the seller. Clear? Basically these types of risk are basically faced by the seller, and that is comes under the buyer risk. Clear? Basically buyer risk. Clear? Second one is the seller risk. Clear? Basically seller risk. Clear? So what are the seller risk? Basically this risk is faced by the buyer. That is, the buyer faces the risk relating to the seller. Clear? Basically here B already made payment to the A. We can say that, but A does not deliver the goods. Clear? Basically the buyer risk basically the buyer faces the risk relating to the seller basically not shipping the goods. Clear? Basically not shipping the goods after receiving advance payment, or may ship a poor quality of goods. Clear? And may ship the goods basically after considerable delay. Clear? Like we can say that basically we are ordering the lights or colors basically for the festival of Holi. Clear? But we are getting, or basically we are getting our order basically after in the month of April. Clear? Holi is basically in the month of March. Clear? Basically considerable delay. Now basically we are not requiring these types of things. Clear? So basically may ship the goods after considerable delay, which may either lead to the cancellation. Clear? Basically which may either lead to the cancellation or delay in further orders. Clear? Taken by the buyer, or even penalties in delays or non-payment or non-shipment. Clear? So over the period. Clear? So over the period basically when the buyer and seller. Clear? Over the period basically when the buyer and seller undertake a few transactions. Clear? Like they are dealing from the last 3 years. Clear? Though they know very well each other. Clear? They know very well each other and their business also. Clear? So over the period basically when the buyer and seller undertake a few transactions, basically know each other business practices and commitments as well. Clear? And commitments well, the buyer and seller risk reduces to a great extent. Clear? So in that case basically the buyer and seller risk basically reduces to a great extent. Clear? Because they know very well each other. Clear? Because they know very well each other. Clear? Hope it is clear to all of you. Basically buyer risk, basically this risk is faced by the seller. Clear? Basically when the buyer is not accepting the things, or they saying that the quality of goods is not up to the mark. Clear? Then next one is the seller risk, clear, that is this risk is faced by the buyer. Next, third one is the shipping risk, clear. Now third one is the shipping risk, clear. So basically how shipping risk comes into role, basically it includes risk, clear. Basically it includes risk, basically arises due to the other intermediaries, clear, due to the other intermediate, clear, not due to the buyer and seller, but due to the other in the international trade, like the shipping companies, handling agents, port authorities, local transporters, or even loaders, etc. Clear, basically which may lead to delay or non-shipment of goods in time, clear, or non-shipment of goods in time, basically due to a variety of reasons, like goods being mishandled, clear, or goods abandoned, goods siphoned, goods wrongly delivered, goods delivered at another destination, clear, or goods appropriated for the freight payment, clear, or goods appropriated for the freight payment, clear. So these are the some reasons basically due to the delay or non-shipment of goods in the time, clear. So transshipment risk, clear, transshipment risk is, it is this question they have already asked in the year 2020, clear. What is transshipment risk, clear? So you have to remember, clear, they will ask these types of question directly in the exam, clear. That's why basically we will discuss all the points one by one, clear. So basically transshipment risk, basically strike by the local transporters, clear, basically strike by the local transporters, clear, that is known, comes under the transshipment risk, basically causing delay in reaching goods to the ports or strike by the porters affecting loading of goods into the ship. Third one is the backlog or unavailability, clear, basically backlog or unavailability of containers, basically due to the delayed train movements or attack by the sea pirates, causing delays, breakage, or loss of goods, etc. Clear? Or attack by the sea pirates, basically causing delay, breakage, loss of goods, etc. Clear? So basically due to the above risk, clear, basically all these risks are beyond the control of the buyer and seller, clear. Basically due to the above risk, basically that are beyond the control of the buyer and sellers, nations at the times declare shipping and other related activities are essential services. Like you can see that basically in the time of COVID, clear. Here basically movement of trucks or heavy vehicles basically from one state to other are comes under the essential services because that it does not arises the shipping risk, clear. It does not arise the shipping risk, clear. That are they are saying the same thing here, basically due to the above risk that are beyond the control of the buyer and sellers, basically nations at times declare shipping and other related activities basically are essential services, basically to promote cross-border trade, particularly when the country is largely dependent either on the exports or imports, clear. Basically today presently the world is totally dependent on other countries, clear, because we need different types of things that are fulfilled, that are basically fulfilled only with the help of import or exports, clear. Basically they are saying the same thing, basically due to above risk basically that are beyond the control of the buyer and sellers, nation at times basically declares shipping and other related activities are essential services, basically to promote the cross-border trade, particularly when the country is largely dependent either on exports or imports, clear. Clear, that is shipping risk, clear. So in this session basically we have discussed three types of risk: buyer risk, seller risk, and the shipping risk, clear. We have to discuss up to this much point in this session, and in the next session basically we have to discuss the other risk also, that is credit risk, legal risk, country and political risk, operational risk, exchange risk, clear. All these risks basically we have to cover in the next session, and along with that basically we have to cover the rating also, clear. Basically with what type of rating basically we will give that, clear, moderate risk, high risk, low risk, clear, all these ratings, clear, because on the rating also one time they have already asked this question, clear. All these are important concepts for your examination point of view, clear. Hope it is clear to all of you, clear, basically what is the definition of risk. And you have to remember that basically risk, it is an unplanned event, clear. Basically risk, it is an unplanned event, clear. You have to remember this word, that is unplanned, clear. And why ECGC is formed, clear, and in which year it is formed. Basically it is a wholly government of India, clear, wholly owned by the government of India, and it was set up in the year 1957, clear. So thanks to all of you for attending this session. Tomorrow basically we will complete the further.